Hi everyone, Ramis Gabriel from IG Wealth Management here. Today I want to talk to you about insurance. Insurance is such a big topic though, so I've broken down what I want to discuss with you into 5 different videos. The first video, which is today's, is types of insurance and riders. What are the different types of insurance and their purpose? What are riders and what are common ones? The second is term versus permanent insurance. We're going to discuss characteristics of each and the cost structure and differences. In the third video, we discuss insurance for children. What are the advantages? What are the options? Because there are several ways of doing this. In the fourth video, we discussed reality of risk. What are the odds, impact on retirement plan, needs, whether mortgage insurance is recommended or not recommended, client protection and ethical standard, and so on. And in the fifth video, we discussed estate preservation. So let's jump right in. As I mentioned earlier, today's video is about types of insurance and riders. As I discussed in earlier videos, IG Wealth Management is one of the few financial institutions that creates comprehensive financial plans. Today we're specifically addressing risk mitigation, particularly as it pertains to insurance. One important thing to note with regards to insurance is that as IG consultants, we are not captive agents. We have access to some of the most reputable insurance providers in Canada, and we have no particular interest in one insurance company over the other. So we look at the most suitable insurance product for your unique situation and offer that to you. As you can see on the screen, we offer insurance from Canada Life, Manulife, Sun Life, and RBC. Next, we're going to discuss the different types of insurance and their purpose. The types of insurance can be split into 2 main categories: life insurance and living benefits. Life insurance is the one that most people are familiar with. It's clear-cut. Upon death of the insured, the beneficiaries receive the death benefit. Living benefits, as the name suggests, are paid out to the insured. The type of living benefits are disability insurance, critical illness insurance, and long-term care insurance. And we will discuss each type of insurance in more detail in the next few slides. So we're going to start with life insurance. Life insurance pays out a sum of money on the death of the insured person. Insurance in general is meant to bring the insured or their family back to where they originally would have been had an event not occurred. In the case of death, the income otherwise generated by the insured would be lost. So the purpose of life insurance in most cases is income protection. In the event of death, the family of the insured should recoup the lost income. So in a family context, a working spouse or parent needs to be insured to replace his or her income in the event of death. For example, if both spouses are working and both of their incomes are needed to pay the mortgage. In fact, if one of the spouses dies, the other has to qualify for the mortgage on their own. If they don't qualify, they will be forced to sell the house. But even if one spouse is a stay-at-home parent, they also need to be insured due to the cost savings that they provide. For example, if a stay-at-home parent, God forbid, dies, the other parent will likely need to hire someone to stay with the kids, to clean the house, perhaps they will eat out more often, and so on. So the other parent will have to pay someone to do the work that the stay-at-home parent was previously doing. Another purpose for life insurance is asset protection or estate preservation for the next generation, but that will be covered in the 5th video. Next, we are going to discuss disability insurance, which is the first living benefit. Disability insurance is an insurance product that provides income in the event a worker is unable to perform their work due to a disability. The purpose of disability insurance is to replace income lost due to cessation of work resulting from a disability. This insurance serves employed individuals. One important thing to note is that you are only eligible for a maximum of 85% of your pre-disability net income from all sources. Meanwhile, your costs during a disability may be higher, especially if you are paying for treatment. There are some riders that can mitigate for this, but this is outside the scope of today's presentation. Next is critical illness insurance. Critical illness insurance is a product where the insurance company makes a lump sum cash payment if the insured is diagnosed with a type of illness covered by the policy. The purpose of critical illness insurance is to alleviate the burden of medical expenses or loss of income as a result of a specific illness. This type of insurance serves working parents, stay-at-home parents, and children. Traditionally, critical illness insurance policies covered heart attack, stroke, cancer, or bypass surgery. But now most policies cover up to 22 illnesses or conditions. This is the list of the 22 conditions covered by most critical illness insurance policies. As you can see, many of them are quite severe and could cost substantial amounts of money for treatment. In fact, this is an article that discusses the financial difficulty of affording expensive surgeries. Some surgeries require coming up with tens of thousands of dollars in a short period of time. Some people had to sell houses or go into debt in order to afford these surgeries. Critical illness insurance provides the cash necessary in these situations. And finally, we have long-term care insurance. This is an insurance product which provides a weekly benefit if the insured is unable to perform 2 out of 6 activities of daily living. This is so the insured can live in a nursing home or have a live-in nurse to help. So riders, what are riders? In simple terms, a rider is an add-on benefit to an insurance policy. This is to add benefits to the basic insurance policy in order to meet more needs. For example, one of the common riders is loss of independent existence. This rider covers what a long-term care insurance would have covered. If a critical illness policy includes this rider, loss of independent existence will be included as a critical illness insured condition under the policy. This rider typically covers cognitive impairment as well. Second event rider is another common rider. Under a regular critical illness policy, after an initial event and payout, the policy expires. With the second event rider, the policy remains in force and pays out if a second event occurs. The second payout is half of the benefit amount to a maximum of $50,000. There are also certain criteria that need to be met in order for the second event to apply. Another common rider is return of premium rider. This rider allows the parent or child to receive 100% of all the premiums if there was no claim on the policy, typically around age 25. This money could serve as a down payment on the house or to pay off student loans. This allows the child to get a start on life. The final rider on our list is child term rider. This is a rider that is added to the parent's life insurance policy. Most child riders can be converted into a permanent policy once the child ages out, sometimes at 3 to 5 times the amount of the original rider coverage. For example, if you have $10,000 in coverage on your child rider, you could convert it to a $30,000 whole life policy for your child. Also, just note that not every rider is available for every type of insurance. For example, loss of independent existence and second event riders are for critical illness insurance policies only. Return of premium riders are for critical illness and disability policies only. And child term rider applies only to life insurance policies. So that's all for me. Thanks for watching, and be sure to watch the other insurance videos.